Hey everyone, Skywater Technology is one of the most innovative semiconductor businesses in the world today. It's a US based manufacturer, so it's going to benefit from the CHIPS Act, which aims to dole out billions of dollars to encourage US manufacturing. So in this video, I'm going to look at Skywater Technology stock, evaluate its prospects, revenue, cash flow, profit margin, and look at the valuation and determine if I think this stock is a buy right now. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Skywater Technology stock price is down off its highs of over $32 per share. It's now trading at $12 per share. Of course, it's gotten a boost in recent months. So the company has done a good job growing revenue at 286.68 million in the most recent trailing 12 months. That's up from less than 150 million in the trailing 12-month period in January of 2021. Given the rising demand for innovative technology and the bonus manufacturing boost coming from the CHIPS Act, I'd say Skywater Technologies prospects are solid for the next couple of years, although not excellent, right? Their expected revenue growth rate for the next couple of years is roughly in the low double digits, high single digits, 12-15% for the current 2024 year, and then less than double digits for the next year. Although longer term, its prospects could be even better as it uses this money and increases its manufacturing capabilities. I want you to understand economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. And so now that you've understood economies and scale, you can understand that Skywater Technology is not really demonstrating that, right? You can see from January of 2021 to the most recent update, it hasn't really made much progress in its operating profit margin, and it's been volatile up and down in the last few years. The next thing to consider is the cash flow from operations to sales. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. And so even in this metric, we haven't seen that steady upward movement for Skywater Technology in its cash flow from operations to sales, although it is excellent in the last, I would say, from January of 2022 onward. If we ignore this part before 2022, it has moved back to positive territory to 3.56%. And finally, I wanted to look at its valuation. It's trading at a forward price to earnings of 28.85, which is relatively inexpensive according to its own history. If you look back, this is roughly the lowest price you've been able to get Skywater Technology according to this metric going back several years. So that being said, given its lack of improvement in operating profit margin and the relatively modest growth rate expectations for the next 2 years, I would place Skywater Technology stock as a hold. If it continues making progress on the profit front and if it gains more traction in terms of revenue growth and more access to wider customers, I would feel comfortable upgrading the stock to a buy. But for now, according to its current prospects and what's expected over the next 2 years, I would say this stock is better suited as a hold and just place on your watch list and wait for a better opportunity to get into this innovative semiconductor stock. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.